All right, my name is Greg Michalowski. I'm very happy here to be here with you at FX Street. I'm going to talk a little bit about what you see in your charts. Before we get started, let me remind everybody that trading foreign exchange carries a level of risk that may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure. Should you decide to trade foreign exchange, carefully consider your investment objectives, your experience level, and risk tolerance. You can lose all or part of your risk capital. So be aware, be prepared. This is about who I am. I've been in the market for over 28 years now. Was in the market, institutional market, for 15 years as a trader. Been at FXDD, retail broker, now since 2001, the first day it started. I have a book called Attacking Currency Trends. I'm a contributor to FX Street, working on some a special video for them. As a matter of fact, as we speak. And then, the different publications on Twitter, so on and so forth. You can follow me daily at livestream.com/FXDD. And if you recall, last month in my webinar, I talked about kind of trying to increase the odds of success in your favor. And that was so I want to just do a quick review of that, and then I'm going to transition into what you see in your charts. What do you see in your charts, given the way that I look at the market? Because I came to a realization. Folks, that it's not just because I've been, as I said in the previous slide, I've been in the market now for 28 years. I look at these charts all day long, and it might be that what I see is different than what you see, and the focus can be a bit different for each of us. And so what I want to do here today, just give you an overview of what I am going to do, is I'm going to take a look at some real markets. I'm going to replay a market scenario, a couple scenarios, and just kind of go through my mindset about what I see in the chart. And hopefully through repetition, from your standpoint, and repetition comes from perhaps coming to that livestream.com website and listening to what I see, read my book, so on and so forth, or even your own trading repetition. You become familiar and are able to focus on what you are trying to see in a chart. And I'm going to try a little bit something different here. First, I'm going to try to share a video that I have that's on YouTube, and there's no voice to it, or there is actually, but it says what you should be doing. This is some of you may have seen this in the past. It is talking about or it's a video that will kind of surprise you. And I'm going to make it full screen here. I assume that you can read, or that it says right now, count how many times a player wearing white passes the ball. And that's, you're going to see 6 people on the screen. There's going to be 3 in white, 3 in black, and they're each going to have one ball. Each team is going to have one ball. And they're going to pass the ball back and forth. And what I want you to do is focus on the people in white, and count how many times they pass the ball to each other. Now, can I just get a confirmation that you are able to see the YouTube site right now? Yes. Okay. Good. Now I'm going to make it full screen so that you all can focus on it, and then I'm going to start the video up. Okay. So count again the people wearing the white shirts, and here we go. It only takes about a minute. Did anyone notice the gorilla? Did anyone not see a gorilla in that video? What studies have found by showing this video to a lot of different people is that there is, in fact, a number of people who don't see the gorilla. And I'm going to play it through here again just to show you. And then I'm going to bring out some other things that happened during the video that may have surprised you, including changing the color of the curtain. And also notice how someone in black actually left the stage at the same time. So see that gorilla? See how here it comes. The gorilla comes walking through the middle, does that on his chest, and notice here there's only two people in black now. So one, and then the curtain went from red to gold, and so that's about all. What I wanted to do, or the reason why I wanted to show that video, is because it goes to show that depending upon what you're focused on as a trader, you may not be able to see the trees through the forest. The same thing that I see, because you're so focused on maybe the current, where the market is right now. You don't start to look back and see where are the trade opportunities from what happened in the past. And so that's going to be that's sort of the basis of this idea, how we as human beings, just because the way that we're programmed, can miss a gorilla coming through the middle of the screen. And so what you as a trader have to start to program yourself is first understanding that fact, that perhaps you as a retail trader are missing things just by virtue of the fact that you're new to being a retail trader. And but once you know that, you can start to program your mind to start to think in terms of maybe the broader picture, maybe seeing the picture a little bit clearer, not being so focused on where the pip is occurring, but preparing yourself for the event that's going to happen potentially down the road. That I think is important as a trader. When I kind of came across this video, it was kind of by accident, and it clicked in my head. Being an educator, being someone who tries to teach traders what is important in trading, maybe I've been missing some things, and this I think is a key point. So let's just build a quick foundation about what you as a trader should try to do. First of all, focusing on risk is most important in trading. I assume you see my my PowerPoint now. Is that correct? Just someone give me a quick yes. You see the PowerPoint? Yes. Okay. All right. Focusing on risk is most important in trade. This is one of the most things that you as a trader have to condition your mind to be thinking about. And the way that I express it here is do you think about, I sold the euro at 132.25, my stop is at 132.50, or I sold the euro at 132.25, I am targeting 131.75. Most people on TV will talk to you about the left-hand side, about the reward aspect of it. And the reward aspect of it is not the most important thing. The risk aspect is the most important thing. Because if traders who focus on targeting the reward, that is your focus. Where are we going? What is my profit going to be? What they're saying, if they're truly focused on that, is that are saying the risk is potentially unlimited because they're so focused on making it to the finish line that they forget about the risk side of the equation, or they're more focused on the reward side. Whereas those traders who focus on defining and limiting risk are saying the rewards are unlimited, because you know that if the market doesn't take you out on your stop, then the market is going your way. And so your rewards become the unlimited part of it, as opposed to your risk becoming the unlimited part. So that's the first thing you as a trader have to get a broad understanding of is that the risk is most important than the rewards. So focusing on risk is greater than rewards. And the question now becomes, how is risk defined and limited? And if you were to take or answer that question the way that I answer that question, is by trading near key technical levels called borderlines. And so what are these borderlines consist of? What are the requirements of borderline levels? First of all, we know that they're technical levels, key technical levels. That's step number one. So they're derived from technical tools. And these tools have to do 6 different things. One is they have to define risk. One, they have to be at technical levels where I like to say there's an energy near those levels. Three, they need to show that it's bullish above and bearish below. 4 is seen and used by many. 5 is help define trends, and 6 is reduce your fear. And your technical tools should define that you use those to find key technical levels, find key borderline levels, should satisfy those requirements. And I use 3 technical tools for defining these borderline levels. And people have heard me say these time and time again. I don't change my tune. This is part of becoming my focus. My broad focus is to look at these technical tools in a bigger environment. I want to see the gorilla, okay? And I'll use these technical tools to kind of lead me toward being able to see the gorilla, see the curtain change, see the person in black t-shirt leave the stage. I don't want to be so focused on one little thing. I just want to have a broader view. So my technical tools are the blue line represents a 100-bar moving average, the green bar represents a 200-bar moving average. I use trend lines. Trend lines do all these things as well. There are up trend lines. There are down trend lines. There are channels, and you can't forget the channels in foreign exchange, folks. Channels are most important. There are ceilings and floors as well that use a lot of channels being developed in the foreign exchange market, especially when the market is trending, of course, to the upside or downside. If you break a channel, that means the trend is over. So that's the second tool. And then I use Fibonacci retracement. That's my third tool. And there are 3 main retracement levels. One is the 38.2, the other is 50%, and the third is the 61.8% retracement. And I like to focus on the correction zone, what I call between the 38 and 50% retracement level. Why is this so important? Because in a trending market, if the market is going to trend either to the upside or to the downside, why is it trending? Because buyers are overwhelming sellers. Understand that broad picture, okay? That broad idea. That is, the monkey in the picture. Understand that when the market trends to the upside, the buyers are overwhelming sellers. When the market trends to the downside, the sellers are overwhelming the buyers. And so, as just saying that to yourself and understanding that is important. Now, if the buyers are overwhelming the sellers, and you're going to get up to a point where it's going to run into resistance against one of these key borderline levels or key technical levels a lot of times, not all the time, but most of the time. And when it does, you get a correction. Now, if the market is going to remain bullish, that is, if the buyers are still going to remain in control of the market, I hope my voice hangs in here, folks. This is going to be it for me today. But if the market's able to keep that bullish bias going, it's going to buy, those traders who bought the market up higher are going to be happy to buy it at 38.2% off. It's kind of like the 40% off sale at your favorite store. If you like goods at at the Talbots or Nordstrom's, and you like their goods or whatever they have, if they have a 40% off sale, you're going to go to that store and you're going to buy your goods. That's why they have sales. They want to get you in the store and start to buy, and buy more than what you wanted to buy. That's the idea of trends in retail, and it's the same goes true in trading. If the market comes off 40%, those buyers who bought the market to the upside should be happy to buy the market again at 38.2% off. When the market starts to go below the 50% level, then you start to get a little bit, then your retail store is starting to get rid of inventory. They're not seeing the buyers come in. Those buyers aren't taking out their inventory. They're in an inventory problem, and they start to sell their goods at a discount. Same goes true in the foreign exchange market and other markets as well. When the market goes to the 50%, I like to say the waters get a little bit muddy. And so I like to focus on the 38.2 to 50% retracement level. So now let's talk about increasing the odds of success in your trading by utilizing those tools. And let's look to better the trader odds. And in order to do that, I want to focus on this big E. E. What does E mean? Okay, and specifically E in physics terms or in science terms equals mc squared. And what Einstein said mc squared was energy equals mass times c at something called c, which happens to be the speed of light squared. Now, the speed of light is a constant. And it sounds kind of weird that I'm talking about this physics, but so is finding gorillas in video, so bear with me. But I got to thinking about that equation, about energy, about trading, about having trading with near areas that had an energy, because there's an energy at a level, at a specific borderline level, and you're prepared for that. You see the trees to the forest. You're able to see the gorilla at those energy levels. What defines those energy levels? And energy levels in trading, to me, are created by, instead of mass, multiple reasons to trade, which moves the market away from the point of the trade, sometimes fast, like a jet plane. So more M in the equation, E equals mc squared equals more energy, and more. If you have multiple reasons to trade, you should have more energy. All right, so now I'm going to transition into the next phase here, which I'm going to share a video with you. I'm going to share a video file with you here. Share file. I'm going to put up this one right here. All right, so you should now see a screen here of the euro versus U.S. dollar. Is that correct? It says an hourly chart. No. No. Okay. Share from my computer. Black. Okay. Maybe it's transit. Play button. Okay, let me hit the play button. Do you see anything now? Yes. Okay, there we go. All right, I'm going to pause this right now here, and because I got to set it up here first for you. All right, this is so you all can see the euro versus U.S. dollar. Yes. Okay. All right. What I want to do for you, and maybe if you see a black screen here, let me see here. There. Okay. All right. Good. This is the first time that's been done at FX Street. So we are going into a new areas that we've never been before. We've seen gorillas, we've seen energy equals MC squared. Now we're doing video. So here we go. This is the euro versus U.S. dollar, and actually is the day after the unemployment report. And during this period right here, I just want to set up the chart and get you thinking about when you look at a chart and you see the tools in the chart that I use, the moving averages, the Fibonacci retracements, the trend lines. You can't just be focused on what's at the end of this chart, what is happening right here, okay? You need to be focused on what happened back here, okay? The last question I'm going to ask is, do you see my cursor going around? No, okay. Maybe I have to start the chart. Okay. All right. So what you have to focus on is the yellow areas and what happened in the past. and also the moving averages. So when you look at this chart and you see the yellow area on the bottom there, that just defines, if you just look at it in the broadest sense, with seeing the gorilla, you can see that the market is traded below that level around the 131.68 level, and then it moved above that 131.68 area, and it traded above. And so we had two areas, one trading below and one trading above. It's kind of a dividing line, a borderline, a level where if you go below that level, that's bearish. If you stay above it, it's bullish. The same token on the top, we have a ceiling, and that ceiling at the top yellow area is where the price has stalled out, and we did go above it on I guess July, the last day of July there, maybe until August 1st. But that was brief, that was short-lived, and then the market moved from failed at that top level and then moved back down. And notice this is the day after the unemployment. I know you don't see the cursor, so I am explaining it, but and hopefully when I start the video, when I start the video, people I think can see the cursor. But I just want to get you to the point where you understand where the chart is, and then we're going to zoom in. All right, let's go through this. And what you as a trader have to be thinking here is that, all right, we're above those two moving averages. That's the green line and the blue line in the chart. Okay, so we're back above those two moving averages. We're also we're below the yellow area. We're below that trend line. So if we were going to trade this market, for me, I would say get above the yellow area on top and the trend line. We're going higher. Move below the 100 and 200 bar moving average on the downside, and we're going lower. Now so that's what I'm thinking ahead. That's me looking at this market and looking at them at it. And now I've started the market movement. All right, so I do have some things in here that's going to show the market. So we're okay here. So here are our initial borderline levels. We're defining risk against the top side of the yellow area there, and we're defining risk against the bottom side, that blue line on the downside. And since the market on Friday moved above that 100 and 200 bar moving average, we're on this day right here, I'm going to be a buyer on the dip, a buyer against that 100 bar moving average. Now, when I buy, I have to focus on risk, and so we see the market. We define our risk against those two moving averages. Stay above those two moving averages, and the bias is bullish. So for me, this is all set up by looking back, by seeing the gorilla, understanding where the key levels are, and trading against those levels. So there's my blue line. That's where I bought, and now I have my risk defined on the downside. And really, the gain or loss is dependent upon whether the market agrees with what I have to say. And so far, the market is agreeing with what I say. The market came down. I bought the market at that near that low level, against that level, and now at this point right here, we actually made new highs for the day. Now, the range for the day is only 23 pips. At that point, is 23 pips a big trading range for a day? We're about 8 or 9 hours into the day. And the answer is no. So I'm feeling a little bit more confident about the position. Now, what happens here? We head up, and we go right to the top side of the yellow area at the 133 level. You see that? You see that level up there? 133, even. And the market stopped right at that level. So if I'm long down below at, near the, like the 64, 65 type level, I want to, need to get above these top side levels. I need to break above those levels on the top side, right? And if I can't get above those levels, the market's going to go down. So we go up there, we stop, we go up again, and we stop and find the sellers. We're starting to find sellers. And what happens now at this third bar? Remember, this is an hourly chart here, folks. The market stops at that level, and the buyers become sellers. So at that point right there, it's like a red flag goes up, and the market comes down. Do you see it? Do we see? Oh, we're okay now. Okay. So we start to see the market coming down. Okay. Now, the market now broke through our 100 and 200 bar moving average. So if you were still long, you'd be getting out of the position right now. And you start to look toward the downside of where the market is going to go. Now at the bottom here, we hit that our 61.8% retracement. And if you were to enter a buy against that level, and again, it also corresponds with the low from the previous day, and we start to, if we start to move back above that 100 and 200 bar moving average, you are going to actually, see the market turn around. So that area right there, that buy zone, becomes an area again where it's a key level that you want to trade against. Let me go back. Let me go back to that end line there and replay this. So the market's coming down, and the market comes down to our next target level, down at that 61.8% retracement level. Buyers are entering against that level. Why? Because look at the previous day. The market has those highs there. That was a ceiling, and when it broke above those highs, everything was okay. And the market rotated back to the upside, and then we head into the closing level here, and the market starts to close itself off. So up here, this is a sell zone up here. Up here, you want to be up toward the top end at the yellow area. If it can't get through the 1300 level on the top side, at the highs right there, that is going to at the yellow up area up there around the 132.99 level. If we can't get through that level, that means that the sellers are taking control. At that point right there, if you can see the gorilla in that yellow area, how it's so important as far as getting above it, and you sold against that level, you want to be more of a buyer down below when the market starts to break below that 100 200 bar moving average. And if it doesn't go and stay below that 100 200 bar moving average, that's where you want to buy the market. All right. I wish I had the cursor, and I wish one of the little problems, I guess, in this in the seminar, in what we're doing here as far as the video goes, and I apologize for it, is when I do pause the screen, it goes black. So I'm sorry about that, but just try to bear with me and I guess try to see the flow of the market, and I'll try to explain it as well as I possibly can. So if we were to look at the next chart the next trade that we're going to look at is going to be a day later, and I'll try to outline it here in a quick. So this is our move to the downside. We saw the market up here. Market came down. We squared ourselves when the market moved back above this level. And the next day, the market came back down to our 61.8 and started to move higher. Now, we got above the 50% and the 38.2%, or above this yellow zone here. So we're starting above the bullish line there, above the yellow area. And what do we have to do? We have to stay above that level. Now, I also put in a Fibonacci retracement from the day's low to the high. And as long as we stay above the 38.2 to 50% retracement of that area, that is going to be bullish as well. So here we come down to the 38.2. Remember, if you can buy something at 38.2% off, you want to do it there. And where is the risk? Down below at that 50% retracement level. What are our targets on the top side? And our targets on the top side become the previous highs. So in a trade, you want to be able to see these levels, understand where these key levels are, and if the market holds those levels, you're okay. If the market goes and takes you out, then you're not okay. And so being able to understand where the technical levels are by using the tools of your trade, using the tools that we can define risk and limit risk against, and have multiple reasons. By the way, this is the 50% of the move down from the July high to the August low, and also represents a 38.2% retracement level. So there's a couple reasons down there. And so the market goes down and it goes below that line. You're stopped out. All right. The market went below those levels and the market stopped you out. So you have to listen to that area. Now let's pause the market here. And what do we notice down below? And this is where multiple reasons to trade come into play. We have the trend line support, 1, 2, 3. We have the 50% retracement, and we have the 200-hour moving average. Is that level important? It sure is. And remember, this is fast market motion because This is an hourly chart. So the market went down to that key technical level, not only once but twice, and the market settled against that level. So so at that level, you have to be a buyer again. Why? Because multiple reasons to trade. 200 bar moving average, trend line support, 50% retracement level, 100 bar moving average is down below. You can define your risk. And what do we see the market do? We see the market move back above our yellow area, and it gives you a second chance to get in from the long side here. What are our targets on the top side? Our targets become the yellow area. It becomes the previous highs. It becomes the highs. It becomes the high going all the way back to July 31st. And as the market moves in your direction, you have the opportunity to continue to move your stops up along with it. And as you can see here, the first trade that we had for the day initially held that 38.2% retracement and then stopped. It stopped at that it stopped at level, moved higher, but we weren't able to get above the previous highs. When the market failed to get above those previous highs, that's when the market stalled out. It stalled out, and then we saw the sellers enter. That first trade was a losing trade. The second trade down to better support area defined by moving average, trend line, Fibonacci retracement, and those are the levels that you as a trader have to start to focus to be able to see those trees to the forest, be able to see the monkeys or the gorillas coming into play there. So I want to go back now, if I can find it here. Okay, I want to go now to my desktop or to my charts here. And all right, now let's go to the hourly chart and go back to that last move to the upside here that occurred on in the beginning of the month. And I'll zoom out here. And this was the day that we just looked at here. The day when the market came down, we fell below actually it was right here. We fell below the we fell below the line, came down to our 100 and 200 bar moving average, our trend line, our Fibonacci retracement. I'll recreate it here. I'll put the Fibonacci retracement here from the high, from the low to the high. Came down to the Fibonacci retracement here. So we had a trend line. We had the 200 bar moving average. I think it was actually off of this move right here. It was off that low. Yeah. So we had a Fibonacci retracement. This trend moved to the upside, came down, found support there. Market moved higher. Market stalled up at the high right here at around the 133.40, 44 level. So if you as a trader become focused on seeing the trees to the forest, understanding where there's multiple reasons to trade right here on the single chart right here, you might have been the recipient of great trade location. Risk was defined against the 100 bar moving average. You could have bought the market here for the multiple reasons how the market moved in your direction. Now, I want to focus on for the time being on, and then we'll move forward. But I want to focus on here the 133.44 level. Now, we know that the high existed here, and so the market stalled at that high right there. And we actually had a little corrective move to the downside off of that high. If we go to the daily chart, and I'm going to zoom in here. And I'm going to go back to that date right here, where the market, this is the day right here, where the market moved higher there. And what do you notice here about this area here where the market stalled out at 133.44, the actual high was on the hourly chart. And if you notice here, you take the high for the year and the low for the year, and the 61.8% retracement came in right at that 133.42 42 level. Now, the market high came in at 133.44 for this day. So the market moved a little bit above that 42 level, but that's where the market stalled out. Also notice here that we have a trend line coming down here. This trend line connects here. Oops, I'm going to zoom out here and show you how far this goes. And connects this high. So we had a high here, we had a high here. The market, this line continued down here. And on that day, on the day that you just looked at, we stalled out at the high. It was toward the close of the day, right near that trend line, right near the 61.8% retracement level. Is that level a key level? I'm gonna come back a little bit here. I'm gonna zoom out here and just show you this level again. Is this level right here a key level on the daily chart? And my answer to you is yes. You know, it's a key level. It's a multiple reason level on the daily chart for the market to stop at that level. It was a 61.8% retracement of this move to the downside. It was a trend line coming back all the way back to whatever year that was that the two highs connected. And so this level becomes a key level. So going back to our hourly chart, are we surprised that the market stalled out at this level and we saw this corrective move down off of that high? And the answer is no. I'm not. The market. So in reality, on this day right here, if you were aware of the gorillas in the room, you would have been able to find support down here. You would have find resistance up there, and take the entire move. Now, you know, it doesn't happen all the time. We don't know what the future is going to bring. We didn't know the market was going to go all the way up to that level. But we do know that the market followed the rules along, and you as a trader could have managed your trade if you get great trade location. And getting great trade location is about seeing the gorilla in the room, understanding where those key levels are, and knowing that the gorilla is coming, and he's going to beat his chest right in front of you, and he's going to say, this is a level that you have to trade. So try to find these levels before they even happen. If you know there's a gorilla coming, look for those levels. On the same token, watch the top sides, watch the targets, understand where those key target levels are as well. And progressing through the trade here, the market moved higher. You put your Fibonacci retracement on there. 38.2% retracement comes to that level right there. Let's even take this corrective move right here and look at this move to the upside. We fell short of the 38.2. What do we know about this 44 level, 42 to 44 level? Start to get above that level. Look for buyers to enter against that level. Now, it was a little messy here. It raced actually through the level and shot up higher here, or we ran into topside trend or the underside of the trend line resistance, and we saw the market come back down. But note here, another key level here, or another key clue for you intraday is you know this level is key, and you know that the market moved higher and it came down, and it actually moved below that key level right there. Trouble. Yes, but it doesn't make this level any less important. This level is still important, and so when the market bottoms here and starts to move higher, you have to be a buyer in this level. Even though you have to be able to see that support, understand that there's going to be support there, or that risk can be defined against that level, and get back on that trend. Get back on the trend through the level, through the highs, through the tops. And again, it becomes another trade for you in the trade. All right, now let's see. I got about 10 or so minutes to go here, and so I want to talk a little bit about the top here and how the market peaked out over here, and also with an idea of taking a look at what the market was telling us through technical tools. First things first, market's in a trending market here. Draw your trend line, okay? Draw a trend line up there. I always like to draw parallel trend lines. If I see a key or a trend line that has a number of different points on it, and this has a number of different points on it, just put a parallel trend line up there. You never know when the market's going to come up to that topside trend line, find resistance. You'll be selling up here, taking your profit, doing whatever, and seeing the market come down. Did it get up to that topside trend line? No, it didn't. So we're losing some momentum here. The momentum through here starts to be lost. Where else do we start to lose momentum? We start to lose momentum when we start to go below this trend line here, right? It starts to move below that level, and then the market starts to come off a little bit off of that level. Note here we have some lows here. We have highs up here at the 133.90 level, and this is that move to the upside. Okay, this is the move on the daily chart to the upside. Now, what do we have up here at the 134 level here? Going back in time, if you go up to this level right here, and actually, if we if we connect highs, we're kind of near the upside resistance line right here. We also have this high going back to June. And so we got within about 15 pips of that level, and the market started to rotate back to the downside there. So we're seeing some reluctance on the top side on the daily chart at the top. And we start to see a high here, a high here, a high here. Now I want to go, this is on the hourly chart. Now I want to go to the 5-minute chart here, and I'll end with this here just to show you, to look at, why looking at multiple time periods become, most important. First thing, but before I go there, I'm going to put a Fibonacci from this recent low. This was the trend move to the upside. And we're going to look at this 72 level. Really, if the market starts to go below the 72 level, below the 63 level, this is where you start to get worried a little bit about the bullish bias in this market move. If the market starts to move below the correction zone, move below the 38.2, move below the 50% retracement level, that's when you start to get a little bit worried about the bullishness, and you start to think about that the market has run out of steam to the upside. We don't know what the future is going to bring. All we know is that is where the market starts to get a little bit muddy. Now, I want to take a look at the 5-minute chart here. And if you look at the 5-minute chart, and the blue line again represents a 100 bar, the green line represents a 200 bar moving average. And if you look at the 5-minute chart here, what do we see happening in the 5-minute chart? We're staying above the green line. We're staying above the blue line for the most part. In fact, the market here came down to the green line on this little correction into the Asian session that typically happens. And we start to find support against that 200 bar moving average. We start to move above the 100 bar moving average. And these two moving averages come together right here. Is this a level? Is this a reason to trade the market? And for me, yeah, it is. We're in a bullish environment. We have 100 and 200 bar moving average. We've held the 200 here. So intraday at least, it's a level where you want to be. You want to pay attention to. You want to see if the market holds that level. If it holds a level, then you want to turn your idea into thinking, well, okay, let's see what happens. And the market indeed does go to the top. We start to move higher. Everything works out. If you got long against those reasons, you had a nice little trade there. Sorry, it's starting to go. The 38.2 to 50% retracement level. I just put a Fibonacci from this low to the high, and so we're trying to see if this bullish bias will continue off of this high. What do we know about trending markets? We know that trending markets transition into non-trending markets or corrective markets. And what we saw on the hourly chart is that we started to trade below the trend line. So the bias to the upside started to lose its momentum in here, trading below the trend line. So we start we start to see it in the 100 bar moving average and the 200 bar moving average as well. So we're getting confirmation from the shorter term chart and the intermediate term chart, the hourly chart. Broke below the trend line on the hourly, broke below the 100 bar moving average and the 200 bar at this point right here, we're still showing bullishness here. We're finding support against the 50% retracement against the 200 bar moving average. At this point right here, we have to see the market accelerate to the upside. We have to see the market start to move higher here. If it cannot move higher, off of this 50% retracement level? Is it going to go higher? If it cannot accelerate off the 50%, are we selling enough goods at the store? And the answer is no. So we start to see the market start to waffle back and forth. We go up to the previous high, start to see sellers. We move down through the 50%, down to trend line, start to move up again. And admittedly, we're having a bit of a trouble here, but the market is non-trending. Think of it as the market has a decision to make. The gorilla in the room when the market starts to consolidate and chop around like this is look for the break. Look for the break. Look for the market to give you a clear clue as far as which direction it wants to go. We come up to the top. This is a parallel line, a line here to the bottom here. So nice little channel right there. You can draw two points here, come up here, boom, parallel line there. And what do we do here? We come back down to the trend line, come up to the 100 and 200 bar moving average. Market's starting to move down, and then we get the sell-off to the downside. We start to see the market sell off. One final little rule, again, or especially in a trending market, is that if you, and this is a way that you can see the trees through the forest and see the gorilla in the room, is understanding how trends tend to work. I've talked a lot about the 38.2 to 50% retracement level. In a strong trending market, you're going to see something like this occur, where the market has a trend move to the downside, corrects to our retracement area here, 38.2 to 50%, and instead of stalling out like it did up at the top here, we came to the 50%. We wanted to see the market develop the momentum to the upside here. Did it? No. The market sideways instead. In this move right here, market fastened directional move up to the 38.2 to 50%. Did we see the movement to the downside? You bet. We saw the movement to the downside. If you didn't sell here, this is actually a good trade on the break to the downside here. Look for those opportunities to first on any quarter correction, put a Fibonacci in, especially or any sort of trend-like move. Trends are fast and directional, tend to move in a large trading range. Look for the 38.2 to 50%, and then follow through to the downside. If you did that, you got good trade location here, underside of the trend line as well. Risk can be defined right here. Risk is limited against the trend line, against the 50% retracement level. If the market moves below, you're okay. If the market moves above, you're out. Doesn't matter. You lost a little money. That's what happens. See the next move to the downside. We see the market come down to the 50% up to the 50% retracement level. It didn't exactly zip through to the bottom side. In fact, we kind of sideways through. That's because it was a Friday. But we kept the integrity of the downside here on Monday when the market opened up. We went down to our lows. We corrected up to the 38.2. I know we were above the 100-bar moving average, and if you didn't sell here at the 38.2, you had to sell here on the failure of getting above the 38.2, and the market moved down. Same goes true here. Look for failures in the market. All right. I'm going to wrap up right there. I appreciate everyone's support here and patience. It was kind of I guess, as far as the technology. I wish I had don't look at this. This gets too confusing here. I wish I had the cursor to help you along with the videos and be able to slow it down, but that's okay. That's okay. You live and learn. If you don't try, you'll never know what you can do. But the theme here today, folks, is that if you're having trouble with your trading, don't feel like you're alone out there. Okay, you are learning. You are nervous. You have fear. You have you're not able to see the you're not seeing the trees for the forest. You're not seeing the gorillas in the room. If someone tells you that there's a gorilla in the room, you're going to have a better chance of seeing it. If I'm telling you that here today, that's what I wanted to do. Is to be able to tell you that it's okay. If you don't see what I see, that will come with time. In the meantime, try to think ahead. Think where the key levels are, as opposed to reacting to where the market is or what the market's doing. If you, the best traders in the world know where those key levels are. They're going to trade against those levels. They're going to see the gorillas in the room. They're going to see the curtains change color. They're going to see the black shirts leave the circle, and and that is when you start to put things together and a little bit more, you become a better trader. All right, that's it. I'm done. Thank you very much to the FX Street people. Hope you enjoyed it, and tip your bartenders at the FX Street. They're good people. Thanks a lot. We'll see you next month. My name is Greg Michalowski. This has been an interesting time. Bye-bye there.